I'm Michael Smith.
I'm Chuck Osborne.
And welcome to the Iron Capital Podcast,
where we break down investment stuff with anecdotes and stories that non-financial geeks can understand.
Hey, this is Michael.
And this is Chuck.
It's Wednesday, January 3rd. This is the 8th episode of the Iron Capital Podcast. Happy New Year.
Happy New Year.
So let's get to it. Chuck, what is on your mind?
Self-interest, Michael.
Oh.
People are self-interested. And sometimes, especially in our industry, that ends up kind of skewing things in ways that people don't understand. So there's an interesting quote. I'm going to my glasses so I get it exactly right. From Michael F. Price. Of course, you know who Michael Price is. But for our listeners, Michael Price, he was with Mutual Shares, which got bought by Franklin Templeton, and he ran Franklin Templeton for years, and then he left there and started his own hedge fund organization. But he's a legendary investor, has been in the investment business forever, or was. And he has this quote that is actually on our website. It's been on our website since day one. Wall Street is in the business of generating fees for Wall Street, period. It's not in the business of getting good investment results. You have to be separate from Wall Street to do that. And we talk about this a lot. We talk about how there's conflicts of interest in the industry, but I don't ever think we delve into like how do they actually manifest themselves, and so that's really what's on our mind.
Well, let's start, and I always want to start here really quickly. I think we can be succinct. Let's explain like what is the point of Wall Street. Let's start from the beginning.
Sure.
Why is Wall Street there, and what is it supposed to be doing?
Yeah, well, a lot of people just seem to believe that Wall Street exists and companies go public just so investors can save for their retirement. That is not, that's not Wall Street's purpose. No. Wall Street's purpose is actually to create capital or allocate capital to businesses. So, if you have a business and it's large enough and successful enough, and you need capital, you need money to, expand and grow, you go to a Wall Street bank, and they will either issue a bond or you can sell shares of your firm and stock, and therefore give you capital.
Yeah. And
that is what Wall Street's purpose actually is. So it is to actually help their clients, which is really corporate America, get capital.
Yeah, and that still hasn't changed. That's still the point.
That is still the point.
That is still the point.
Yeah.
Yeah, and when they sell bonds or stocks to investors of any type,
right,
they make a fee off of that sale.
Right.
And they generate income from that.
Right, and really, and that is an important thing to understand, because they're doing their job. This company, whatever it is, needs to raise capital. Let's say in the case of a bond, right there. So they're going to raise capital by borrowing money, by issuing a bond. The Wall Street banker's job is to get them the best loan that they can get.
Yep.
And they really are working for their client. They're not working for the bond investor who ends up actually supplying the money and the capital.
Yeah.
That is not really their purpose.
Yep.
And then once the investment has been purchased, Wall Street's made their fee, their client has their money. That's it. How that investment turns out is really
beside the point.
It's
beside the point.
It is.
And that was it still is very attractive, but it was a wildly attractive investment for Wall Street and way to make money for Wall Street, especially prior to 1975, before deregulation occurred. So commissions prior to 1975 were unbelievably high. Right. And so a stockbroker made huge amounts of money. you have deregulation, it becomes cheaper, and then all of a sudden you have new products
Sure.
that start becoming a bigger part of the ethos there. So one thing we like to talk about a lot is mutual funds, and we use them a lot. They're used a lot in retirement plans which we use. And let's talk about, first of all, the basics of what a mutual fund is. Again, we'll try to be simple and quick here about it.
Sure. Well, really, the way we like to think about a mutual fund is that it is simply a way for the average investor to hire a professional money manager. What you do is you commingle your money with lots of other average investors, and then you're going to invest in this fund who is run by this professional manager, and they're going to decide how that money is going to be invested in terms of what stocks or bonds or what have you, that they invest in. And of course, you pay a fee for that. But as we've talked, in the past in other podcasts about there's a difference between the buy side and the sell side of this business, which isn't talked about as much anymore as I think it should be. The mutual fund managers are on the buy side, so they're hired by their clients to actually go out and make investment decisions, and they first have fiduciary responsibility to those clients, which doesn't exist on the sell side. And then the other thing that happens is that they do care about the results, because if they don't get good results, their clients will leave.
Yeah.
And it's not a transaction in the same sense where, the transaction is taking place, so what happens afterwards is somewhat beside the point. This is, is kind of an ongoing relationship, and you better deliver results, or you're out.
Next guy's in.
Yeah.
Yeah, and so so they really took off in the 80s and 90s. You've got 401ks and IRAs becoming a much larger. First of all, just being born, really.
Right.
But then also becoming a much larger piece. You've got bull markets happening in the 80s. You got some star PMs like Peter Lynch. But I think the real question here is, why were mutual funds, especially as they originally were, so good?
Yeah.
For Wall Street? Why? How did that occur? Why did that occur?
Well, that's an interesting question. I mean, because really what happened is, it gets back to your deregulation question. So, and we talk about this a lot, but the reason Wall Street banks had brokers all across the country is because, as recently as the 70s and even the 80s to some degree, technology required them to have brokers all over the country. If you're trying to sell, stock in Coca-Cola, because Coca-Cola just issued a bunch of new shares, and you're a Wall Street bank, you've been hired by them to go out and distribute those shares, then if you want to do that in Wisconsin, then you have to have people in Wisconsin calling investors in Wisconsin, saying, would you like to buy shares, of Coca-Cola? Today that's 100% done, electronically. Commissions are practically a thing of the past in terms of individual stocks. And the technology has been around for some time now, where people can just do that online. You don't need to actually have someone in Wisconsin for someone in Wisconsin to invest in shares of Coca-Cola. And so, in any other industry where you're dealing with a product that's tangible, that individual would have just gone away. That job description would have just gone away. But in our world, what happened is it evolved to the financial advisor.
Yep.
And so when it became more of an advisory relationship, you started buying, they started using funds more than, just going up and kind of saying, I've got this stock, that I'd like you to buy. And so that's where the mutual funds started taking off. But the reality was, it wasn't great for Wall Street, because now you've got more and more clout and more power being piled into the kind of the buy side of the business.
Yeah, the mutual funds,
with the mutual funds, and the mutual fund companies and mutual fund managers are incented, because everything's about results, and so they're actually incented to drive down the cost of trading, to do a lot of things that aren't necessarily great for Wall Street.
Yeah.
And so that kind of led to the next evolution of where Wall Street ends up going.
Yeah. Well, and which is?
Yeah. Well, there was multiple steps, but I think what we want to talk about today is probably ETFs,
yes,
exchange traded funds.
Yep.
And so the ETF, we'll start with just kind of the history of what it was.
Mm-hmm.
So, again, for the average investor, if you wanted to hire a professional money manager, what you would do is you would use a mutual fund. Mm-hmm. But for the old institutional investors, the traditional institutional investors, like endowments, pension plans, the old-fashioned pension plans, mm-hmm. What they would do is they would go out to institutional money managers, and they would have them be managing a separate account specifically for that pension plan or specifically for that endowment. And that was the business that Invesco was in, here in Atlanta, that where I started, where I worked through the 90s. And so that was a totally different world, where you're unlike a mutual fund investor, where you own shares of the fund, and if you decide that, well, this manager's not doing well, I'm going to switch and go to this other manager, you simply just trade out of that fund and you trade into another fund the next day, and it's a pretty seamless and easy transition. But when you're a large institution and you have these separate managed accounts, if you want to fire a manager because they're not doing well and move the money to a new manager, that's an enormous transition.
Yeah, that's a big deal.
yeah, because you've got to transition the entire portfolio. Mm-hmm. The new manager's probably not going to want a lot of the holdings that were in the old portfolio. I mean, there's a reason you're switching. And so what would often happen is that you'd have these kind of long transitions, and pension plans and other institutional investors would actually be out of the market for a prolonged period of time as they transition from one manager to another. And so State Street came up with this solution called an exchange traded fund. And the first one of which, of course, was simply the SPDR, it tracked the S&P 500.
Yep.
And what you could do is that you would, as you liquidated your old portfolio from the previous manager, you would put it into the ETF as a temporary holding mm-hmm. vehicle. And so you were still invested in the market, you still had market exposure, but then you would use that exchange traded fund, and then as it went over, the new manager could implement their portfolio.
Yep.
And
in stages, small pieces at
right.
a time. They're still invested the whole time.
And at any time during the day, because the biggest difference between the mutual fund and the ETF is how they trade.
Yep.
And so a mutual fund is, again, you're basically setting up a relationship with a money management firm. You can only trade those at the end of the day.
Yeah.
So if you send money, today on Wednesday to any mutual fund family, we'll just use T. Rowe Price as an example.
Sure.
You send money to T. Rowe Price today, then that's going to have an effective, transaction time as 4:00 Eastern time to close the market.
Close the market today.
And then tomorrow you'll be able to see your account. If you sell it, same thing. It's not going to happen until the end of the business that day.
Yep.
And then you have the money the next day. So with the ETF trades like a stock. So it can trade at any time during the day. And so when you're making the transition, it worked as a very good vehicle because the new money manager could simply sell shares of the ETF, buy whatever they're buying, and now you had the advantage of the institutional investors no longer having to have these relatively long periods of time where they may be out of the market as they transition from one manager to another.
Yep.
And so that's what they were. That's what they were made for.
That's how they were created.
Yep.
And now ETFs have become a much larger portion of the total investable world of how assets are invested. But it probably makes a lot of sense to talk about costs in an ETF versus costs in a mutual fund. The explicit versus implicit and
Sure.
how that works. So I think that makes a ton of sense to set up there.
Sure. So with a mutual fund, again, what you're doing, you're hiring an investment management. In the case of mutual funds, they're firms, large firms, and there's cost to that. So there's a cost for an account. You have to have an account with them, so they have to set up an account. There's marketing cost. All these mutual fund families have to go out and market themselves. There's all kinds of administrative costs, and then ultimately there's also the actual cost of what they charge to manage the money,
to make the investment decision.
So all of that goes into what we refer to as the expense ratio. And then historically, and really still today, the mutual fund, you have the total cost. Some of that goes to the actual mutual fund family in most cases, because most people nowadays don't set up accounts directly with mutual funds like they used to. Mm-hmm. They still can, but most folks either go through their retirement plan at work,
401k plan at work,
or they're going through for a broker dealer like a Charles Schwab
Fidelity,
someone
Pershing,
who's operating as a broker dealer. And so a part of that expense ratio will go to that custodian, whether it be your retirement plan provider or a broker dealer, for setting up an account and so forth and so on. And then part of that money goes to the actual mutual fund family to manage the money. And so in the case of a mutual fund, everything is disclosed. I hesitate to say transparent, because you do oftentimes have to dig into the details.
Yeah.
But you know what the total cost.
You know what the expenses are.
Right.
You may not know where they're going exactly, but you know what they are.
But you know what the total cost is.
And all those costs, by the way, are reflected in the returns.
And all those costs are net of the returns.
Yeah.
And so with the ETF, again, it just trades like a stock. So there's no account with the ETF company or anything like that that has to be set up. So that cost is not inside the product. So a lot of those administrative costs are not inside the product. So what you really have in terms of the disclosed price is just the cost of actually managing the money. And most ETFs, not all nowadays, but most ETFs are index-based products. Again, the original was based on the S&P 500, still by far the most popular, and that those tend to be very low cost in terms of the cost of managing the money, regardless of which vehicle you use.
Yep.
And so people will look at ETFs and say, well, that's the total cost, and the cost is much less, but that's not really the total cost. So, again, one of the things we said about ETF is it trades like a stock. And we also mentioned that commissions on stock trades are somewhat a thing of the past now. But commissions, are just the tip of the iceberg when it comes to the cost. Mm-hmm. And so taking the commission away All that means is that you've cut off the top of the iceberg, the part that you can actually see from the Titanic, and or they should have been able to see. And the big part of the iceberg, the part that actually sunk the boat, is still there.
Still there. Yeah.
And it's still below the surface. And most of that is made up of what we refer to as the dealer spread.
Mm-hmm. Or the bid-ask spread.
Or the bid-ask spread,
yep.
Yeah. And so, which is really just, it's industry speak for what happens in any business
dealing. Anytime you sell
in
something.
the world. Right. Yeah, so we just got, we just gotten through the holidays. I'm sure a lot of people have bought a lot of stuff and returned a lot of stuff to a lot of stores. But, if you got a new shirt from Macy's, then the cost, the price that you paid at Macy's is more than what Macy's paid for the shirt in the first place, and that's how Macy's makes money. Mm-hmm. Or any retailer, that is exactly how they make money, and it's the same thing when you're buying stocks or bonds or ETFs. The price that the broker-dealer will pay for the ETF is going to be less than the price that they're going to sell it for.
Yeah, and that's interesting because you don't see this at Macy's or Amazon, but because you can buy and sell. So if you're buying a stock, you could sell it for $1, but then you buy it at $1.05, and you can see both of them in the bid-ask spread. So that's different than when you're doing another business, because you can literally see right now, well, what can I get if I buy it versus what can I get if I sell it? And that is that's what that broker is making on those transactions every time a share sells. So
if you're paying attention.
Yeah, if you're paying attention.
Right, and and there are a lot of folks that just aren't. They just aren't paying attention. And so what happens is, when people say, and they'll make this blanket statement that ETFs are cheaper than mutual funds, when you're actually looking at the total cost, it's not nearly that clear.
No.
And as I had an old boss used to use this analogy all the time. I always loved it. He would use the analogy of a water balloon. And he said, costs are just like a water balloon. If you squeeze one end, you're just making the other end bigger. So mutual funds, again, when you are buying a mutual fund, there is no trade per se. There's no bid-ask spread. There's none of that. You simply buy the mutual fund at the close of the business, and that's, is what it is. With an ETF, you are trading it like a stock, so there is going to be a bid-ask spread, and that bid-ask spread can be quite significant.
Yeah.
It depends. Now, one of the things that drives those spreads down is how popular the ETF may be and how many people are trading it. So the more trading volume, you will tend to have lower spreads. So if you're going just into the standard SPDR ETF, which is again tracks the S&P 500, then the cost is going to be pretty low. And of course, that's the one that everyone always looks at. But if you're just transitioning away from mutual funds and you're just going to say, well, we're going to use ETFs instead of mutual funds, well, now you're not just buying the S&P 500. You're buying emerging markets, and you're
if you're going to be a diversified investor, you're going to be invested. You should be invested in more than just the top 500 largest U.S. Stocks. Or bonds, depending on where you are in your investment. You have a much wider palette of investments that you should be invested in, and and they don't trade at a tight bid-ask spread like the S&P 500.
Right, and so what ends up happening is that the ETF will the farther you get away from the S&P 500, the more esoteric of an ETF you're buying, then the bigger that spread can be.
Yeah.
and that ends up being, it can be a substantial cost to the investor, especially if you are, kind of the average retail investor who is, again, the biggest investment for most people is the 401k plan. And how do 401k plans work? The 401k plan, every time you have a paycheck, you're withholding money and putting it into the 401k plan. So for most people, that's somewhere probably twice a month to every 2 weeks. You're putting money into a 401k plan. So if you're putting constant small amounts of money into a product that actually charges a bid-ask spread, you're getting hit by that every single time you put money in. Away from the 401k plan, a lot of average investors, if they are still in this stage where they're accumulating assets, they still may be saving on a monthly basis, where they have a set amount of money that they're putting aside monthly for their goals outside of retirement, and that money would be getting hit if you're using ETFs just as a kind of replacement for mutual funds. And again, this is where we get back into the self-serving. So now all of a sudden, that charge that we're talking about, that goes to Wall Street.
Yep.
It doesn't go to the money management firm, that actually runs the mutual fund or may run the ETF. And so really, to a large degree, what's happened in the ETF world is that we've had a kind of an economic shift in the commingled fund universe, where the economics used to always go to the fund managers, and now more and more it's going to Wall Street and the transaction cost of being put in the ETF, which is why so many times that they're being pushed as just blanketly better than a mutual fund.
I like to think of it as when a broker was selling individual stocks, let's go back to the 70s more, you had a very large commission but a few trades. People would own a stock for years, right? So they'd pay a large amount once, but it would be very few transactions. You move to mutual funds, and those transactions it's not as good for Wall Street. It's in the mutual fund manager's best interest to trade less, to have less costs.
Sure.
Commissions are much less. You move to the ETF, and now if you buy the S&P 500, every time you have 500 trading costs smaller,
right?
Plus to buy the ETF is one, so it's 501.
Yep.
So from the beginning, Wall Street received a very few large commissions, and now it gets back to Wall Street getting a lot of smaller commissions.
Well, that's right, and that's and this is the thing to remember, that the business of Wall Street is a transaction business, and the more transactions you do, the better it is for them. And so, so when you invest in the ETF, for example, a SPDR, you have that trade of the ETF, but then ultimately the ETF has to actually own the underlying stocks. And so at some point the ETF has to actually go out and buy the 500 stocks that are in the S&P 500. And so, to your point, it's really 501 transactions. Likewise, if everyone's selling, the same, it's the same thing. At some point, they're going to have to sell, and so there's a lot of transactions that are occurring because of the move, away from individual stocks, and even to some degree away from the move from mutual funds. So to some degree, that is also true of a mutual fund. Although with most mutual funds are actually actively managed, obviously you can track the index if you want to. There are index mutual funds out there, but if you have an actively managed mutual fund, first of all, cash is a perfectly good investment in a mutual fund, and most mutual fund companies and mutual fund managers will hold levels of cash so that they don't have to necessarily buy and sell stocks just because of daily transactions that would occur with investors selling or other investors buying,
Yep.
And so forth. The other thing that happens is with a mutual fund is they are traded differently in the sense that mutual fund managers can really shop their trades and trade in a truly institutional manner. If they are adding to the portfolio, they're probably only adding to the stocks that they want to add to.
Yeah.
They're not just blanketly adding to every single stock in the portfolio.
Yep.
If there are some that maybe they're phasing out,
Yeah.
or they just don't want to, because of valuation or whatever, they don't want to add to those particular stocks.
Yep.
They're not doing that. But if you're in a passive ETF, then yeah, you're buying the whole thing.
Yep. Yeah.
Right.
Yeah, and also I think this is an important thing. Again, Wall Street has really painted alt ETF investing with the S&P spider brush.
Right.
But really, when you get down from that and you look at, and we should talk a little bit more about this, when you look at small cap stocks and you look at international stocks and you look at bonds,
Yeah.
a lot of pieces of that just fall away and don't make sense anymore. First of all, from not being able to beat the market as much, to costs and all of that, right? So.
Well, right, and you especially have problems in bonds because there's a finite number of bonds. So you can't just, you can say that you're going to own all the bonds in the aggregate index, or in order to mimic that. But
you can't really.
You can't.
Yeah.
I mean, they're not all for sale.
You can't find this bond.
Right. I mean, there's a finite number of bonds, and they're not being sold every single day. And so, there's just there's all kinds of problems. And we've seen this. We've seen, one of the things that happens with ETFs is that of course, short-term trading can cause dislocations between the actual ETF and the underlying portfolio. But then you also have issues where can the manager actually even track what they're supposed to be tracking, with the ETF, and so you do fall into situations where supposedly you're passively investing in, say, the aggregate bond index or some index, and then the ETF, when you look at the returns, they are not tracking.
Yeah, they're not actually tracking.
Like one would expect if you were in a mutual fund instead of the ETF, and so. So no, there are definitely problems, and that goes in both ways. And we can talk about this because it's a totally separate podcast. But just to passive investing in general, every argument that is ever made about passive investment focuses on the S&P 500, and then they just treat every other asset class as if it's the same as the S&P 500, and they are not.
No.
And so, this was a few years ago, but I remember, vividly because we had a client ask the question. We did the work on it, where we had gone almost a decade where the EFI, which is the big international index, had a zero, almost a zero return, a very low return. But the actual mutual fund managers that we were using that was tracking it for that time period over that same decade had a return that was well over twice the index, and was actually a decent, meaningful return. And so, and we had written about that at the time, which people could look up on our website. But things like that happen away from the S&P 500 that is just ignored. I mean, right? They just. And of course, this is a symptom of our society today. You make one point, and then and then so you just that it becomes a blanket thing that we're not supposed to think about any of the other points or details that could happen, and that is a great example of it, because people they'll look at the S&P 500. They say active managers who are actually benchmarked to the S&P 500 have a very difficult time,
and that's been true,
beating the S&P 500, which is absolutely true, because you're talking about the most efficient part of the most efficient market anywhere in the world, and therefore all active managers underperform regardless of what they're actually trying to do, and that's just ridiculous.
Well, I ran it real quick. We're not going to get too into this, but for small cap managers, the small cap indices of Russell 2000 are in the 55th and 54th percentile if you're looking at value and growth.
Yep.
So that means that the
over half.
Yeah, over half beat, and that's bad managers that have too high expense ratios, right? If you actually just whittled that down to managers that have decent expense ratios, that gets a lot bigger.
Yeah.
And even in bonds and international, now those are like in the 46th and the 43rd, but still, that's roughly average.
Right.
And you have very expensive managers and all these other things. So in all those other very large markets, the average active manager is either beating or very close to the index, and that's not even IDing good ones. So,
we're right, and that's again, people kind of use what's good for them. You know, it comes back to self-interest, and Wall Street loves the idea of passive investing. Partly because it's not passive, and there's been articles in the Wall Street Journal about this, about the amazing amount of turnover that's in the S&P 500, and that no one ever thinks about. But the index itself is getting reconstituted, all the time,
every year,
and there's a great deal of churning that is going on inside of there. The other thing, again, that happens is that it's all about the number of transactions.
Yeah.
And we're talking about the S&P 500 ETF, but if you can actually sell someone a Russell 2000 ETF, well, now you just made 2001.
That's 2001 trades, and the bid-ask spread for smaller companies is larger.
It is, and the bid-ask spread for the ETF itself is larger.
And so
right, and you obviously don't do that trying to make, like, does it actually make sense to do this in this asset class? No, you've got to get people just to kind of have the blanket thought that, well, the spider works, so therefore every other ETF must work.
Yeah.
And it's just, the one does not follow the other.
Yeah. Well, and that's the point. The point, and to get back to the point, is that Wall Street makes products for the benefit of Wall Street.
Right.
And as consumers, you have to keep that in mind.
Right.
Professionals like us, obviously, we have to look at through these things. Individuals do. It's much harder for them.
Sure.
And none of these things are bad in of themselves. It's just that you have to understand what they're good at and when they can be used. ETFs have good use choices. Right. We still like to use them as placeholders a lot. Right?
Well, right. And that is really it. And then one of the things that we kind of think of as a theme that we talk to our clients about is that you need to use products for what they were actually designed to do. And ETFs are a great example of that. Again, you go back to the history. The ETF was designed to be a placeholder. It was designed to be a temporary spot where you still had access to the market. So you were still going to get exposure to the market while you were waiting to make a more permanent investment. And that's the way we use them.
Yep.
So when we do use ETFs, we use them for that purpose because we want to have exposure. We're having a hard time finding specific companies we want to invest in at the moment because of valuation or what have you. So we will buy the ETF as a temporary holding spot, and that's a perfectly good way to use it. if, on the other hand, you're building a portfolio, a diversified portfolio of funds to invest for the long haul, in our opinion, the mutual fund is still
If you want access to other quality managers that are managing specific parts of the market that they are very good at, a mutual fund tends to still be a really fantastic way to get access to.
Because that's what they're designed for.
That's what they're supposed to do.
So you're using products for what they were actually invented to do, as opposed to what Wall Street figured out is is good for them.
Yeah.
And
And individual stocks are still the most tax efficient way to manage money, and we still use those when appropriate and when we can for that, because there's no more efficient way to deal with taxes than that.
Well, that is absolutely right. And there's also, one of the biggest reasons why you don't hear as much about individual stock investing today, as again, Wall Street uses what's good for them.
Yeah.
There is not a cheaper way to invest than to buy an individual stock and then actually be a passive investor.
Yeah.
Which means you're going to hold on to that company for a long period of time. I mean, that's the best, that for a long time has been the best way to invest, and in many ways it still is. And but Wall Street would go out of business if the average investor actually did that, because again, instead of 501 transactions, you're just getting one. Instead of the transactions happening, on a very steady basis, you get a transaction once every 3 years. That's not good for Wall Street.
Yeah.
And so, they're not going to push that approach anymore.
Yeah.
Yeah.
Yeah. Probably it. What do you think?
Probably it.
One day we'll get into a deeper conversation about Wall Street products that have caused maybe the Great Depression or had a piece of the Great Depression with margin, and then we could get into CDOs and collateralized debt obligations in 08 and 09, but that's maybe a different podcast.
Exactly.
All right.
We need, get your caffeine ready.
That's right. So like, subscribe, please, and we love when you guys tell us things you'd like to hear more about. So please let us know what we can talk about.
All right.
Thanks.
Iron Capital Advisors is an independent registered investment advisory firm headquartered in Atlanta with clients nationwide. Learn more about us at ironcapitaladvisors.com. The Iron Capital podcast is produced by Iron Capital Advisors. Our awesome original theme music was written and performed by Michael Smith and Leah Calvert. This content is for educational purposes only and should not be relied upon for investment decisions or advice. Clients and employees of Iron Capital may maintain positions in the securities discussed. Please like and subscribe to the Iron Capital podcast on YouTube and wherever you listen to podcasts. Thanks for joining us. We'll be back with another episode soon.